I've just done something I almost never do. For decades, I've told Americans to stay invested, to bet on this country, to ignore the noise and hold through storms. But today, Berkshire Hathaway is sitting on $334 billion in cash and treasury bills. I've been selling stocks for 8 consecutive quarters. And I need to tell you plainly, we're heading into a period where millions of people may lose their primary source of income, and it could happen faster than most expect. This is my usual measured caution about valuations or market cycles. This is different. I've seen a lot in my 90-plus years, and what I'm seeing now in corporate behavior, in credit markets, in the way capital is moving, it tells me something fundamental in the employment machinery is breaking down. When I move this much capital to the sidelines, it's not because I've stopped believing in America. It's because I'm respecting what's coming. I understand you want the complete script, but I need to clarify the proper workflow based on the prompt system you've provided. In the past 6 months, I've been watching something that reminds me of early 2008, except the signals are quieter this time and more dispersed. Major corporations across America have been announcing layoffs, restructurings, and what they politely call workforce optimization initiatives. Amazon announced plans to cut 27,000 corporate and technology jobs in the first quarter of 2025. Meta reduced headcount by another 15,000 after already cutting 21,000 the previous year. Google's parent company, Alphabet, eliminated 18,000 positions. Microsoft, 10,000. Salesforce, 8,000. These errant, struggling companies on the edge of bankruptcy. These are some of the most profitable enterprises in human history. What strikes me isn't just the numbers, though they're significant. It's the language that CEOs are using in their announcements and earnings calls. A year ago, these same leaders talked about growth, expansion, hiring to meet demand, investing in talent. Today, the vocabulary has shifted. Now, it's all about efficiency, optimization, focus, doing more with less. They talk about right-sizing and returning to a culture of productivity. Mark Zuckerberg called 2023 the year of efficiency and has continued that theme into 2025. Sundar Pichai at Google spoke about sharpening our focus and re-engineering our cost structure. These are code words, and if you've been in business as long as I have, you know what they mean. They mean the growth story is over, at least for now, and the priority has become protecting margins in an environment where revenue expansion is no longer assumed. But here's what concerns me more than the tech sector. I'm seeing this pattern replicate across industries that don't make headlines the way Silicon Valley does. Financial services firms have announced over 45,000 job cuts globally in the first half of 2025. Goldman Sachs, Morgan Stanley, Citigroup, all trimming thousands of positions in middle and back office operations. Retail is accelerating its long decline. Bed Bath & Beyond liquidated entirely, taking 32,000 jobs with it. Macy's closed another 50 stores and cut 3,900 positions. Gap, Nordstrom, Kohl's, all reducing headcount. These aren't just pandemic adjustments anymore. This is structural. The disconnect is striking. Many of these companies are reporting decent profits, solid balance sheets, and in some cases record revenues. Yet they're cutting people. That tells you something fundamental about how corporate leadership is reading the environment ahead. They're not responding to current pain. They're preparing for what they believe is coming. When you see that kind of coordinated behavior across unrelated industries, tech, finance, retail, manufacturing, it's not coincidence. These executives have access to proprietary data about their customer behavior, their order flows, their credit metrics. They can see momentum shifting before it shows up in government statistics, and they're all moving in the same direction. I've also been tracking the language around hiring freezes, which often precede layoffs by 6 to 12 months. Companies that haven't announced cuts yet have quietly stopped filling open positions. According to recent data, job openings in the U.S. fell to 7.7 million in March 2025, down from over 11 million 2 years ago. The ratio of job openings to unemployed workers, which peaked at 2 to 1 in 2022, is now approaching 1 to 1. That might sound abstract, but it means bargaining power is shifting decisively back toward employers. Workers who could once command premium wages and switch jobs freely are finding that leverage evaporating. I look at capital expenditure plans because that's where you see real conviction. When companies believe in future growth, they invest in capacity, new factories, new equipment, new technology, infrastructure. What I'm seeing in the most recent data is a pullback. Capital spending growth has slowed significantly across the S&P 500. Companies are choosing to return cash to shareholders through buybacks and dividends rather than investing in expansion. That's rational if you don't believe demand will be there. But it also means they're not planning to hire. In fact, they're planning for the opposite. The pattern is what I call coordinated retreat. Each individual decision might make sense for that particular company. But when hundreds of major employers make similar decisions simultaneously, they create the very environment they're preparing for. It's a self-fulfilling dynamic, and once it gains momentum, it's extremely difficult to reverse. To understand why all these companies are moving in the same direction at the same time, you need to look at the underlying economic machinery. I've been studying how capital flows and credit conditions shape employment decisions for more than 70 years, and what I'm seeing now is a specific configuration that always, without exception, leads to significant job losses. The Federal Reserve raised interest rates from near zero to over 5% in less than 18 months. That's the fastest tightening cycle since the early 1980 seconds. Higher rates make labor more expensive relative to capital investment. When a company can borrow at 2%, hiring people makes sense even if automation is theoretically possible. When borrowing costs hit 7% or 8%, the math changes dramatically. Suddenly, investing in technology that replaces workers has a much faster payback period. I'm also watching corporate debt markets closely. According to recent estimates, roughly $4.6 trillion in corporate debt will need to be refinanced between now and the end of 2026. Much of that was issued when rates were at historic lows. Companies that borrowed at 3% will now refinance at 7% or higher. That creates immediate pressure on cash flow and forces difficult choices. The easiest place to cut costs quickly is headcount. Not all jobs face equal risk, and I want to be very clear about who should be most concerned. I've looked at the employment data, the automation trajectories, and the specific cost structures of different industries. 3 categories of work are particularly exposed right now. First, white-collar corporate services. We're talking about roles in human resources, middle management, administrative support, junior financial analysis, and various coordination functions that exist in large organizations. For years, these positions were considered stable, middle-class careers. They required education and training, but weren't easily replaced by machines. That assumption no longer holds. Generative AI and advanced software platforms can now handle tasks that used to require human judgment scheduling, basic data analysis, report generation, initial customer service, preliminary legal research. Companies are discovering they can eliminate entire layers of middle management and back office support without meaningful loss in productivity. I've seen internal memos from several major corporations indicating plans to reduce these categories by 30% to 40% over the next 18 months. Second, retail and consumer-facing roles. This isn't just about e-commerce replacing brick-and-mortar stores, though that trend continues to accelerate. It's about demand sensitivity. When household budgets tighten, discretionary spending collapses first. That means restaurants, retail stores, entertainment venues, travel services, all the sectors that employ millions of Americans at modest wages see immediate revenue drops. These businesses operate on thin margins. They can't absorb a 15% or 20% decline in foot traffic. They cut staff. Then those laid off workers reduce their own spending, which creates more pressure on the next business. It's a cascade I've watched unfold multiple times in my career. Third, and this is the category that surprises people, certain types of knowledge work that were considered automation proof. junior lawyers doing document review and basic contract work, entry-level accountants handling routine tax preparation and bookkeeping, content creators producing straightforward marketing copy and social media material, medical billing specialists and insurance claims processors. These roles share a common vulnerability. They involve pattern recognition and rule-based decision-making that AI systems have become remarkably good at replicating. The work requires intelligence, but it doesn't require the kind of creative problem-solving or complex human interaction that's still difficult to automate. Geographically, the exposure isn't evenly distributed. Cities and regions that built their economies around corporate headquarters and large office campuses face concentrated risk. San Francisco, Seattle, parts of New York, Austin, Boston. These metros added hundreds of thousands of professional service jobs over the past decade. Many of those roles are now on the cutting board. The Midwest manufacturing towns that never recovered from previous waves of automation face another hit as the remaining factories deploy new robotics. There's also an income dimension that matters. Workers earning between roughly $50,000 and $120,000 annually are in what I call the squeeze zone. They earn enough that replacing them generates meaningful savings for their employers, but not so much that they have substantial financial cushions to weather extended unemployment. These are people with mortgages, car payments, student loans, and family obligations. A 6-month job search could be financially catastrophic. The company types moving most aggressively are those that took on significant debt during the zero interest rate era and now face refinancing pressures. Firms operating in low-margin, competitive industries and tech-adjacent businesses that overhired during the pandemic boom. If you work for a company that went public via SPAC in 2021, or a private equity-backed firm, or a corporation that did major acquisitions in the last 3 years, your employment risk is statistically higher. Now, I'm not saying these are bad people or that their work lacks value. I'm describing economic logic. When capital becomes expensive and revenue growth slows, companies cut costs. Labor is the largest variable cost in most businesses. These workers happen to occupy roles that have become technologically replaceable or economically vulnerable at the exact moment when corporations need to reduce expenses. It's a matter of being in the wrong place in the economic structure at the wrong time. We're talking about months, not years. The timeline on this matters because it affects how you should think about your own situation, whether you're employed, an investor, or both. I've been watching the leading indicators, and they're all pointing in the same direction with increasing intensity. The current unemployment rate sits at 4.2%, which sounds manageable, but that's a lagging indicator. It tells you where we've been, not where we're going. The better signals are things like temporary employment, average hours worked, and job openings. Temporary employment has declined for 6 consecutive months. Average weekly hours worked fell to 34.1 hours, the lowest since the pandemic. When companies start cutting hours before cutting people, it means they're preparing for worse. Corporate earnings season over the next 2 quarters will force decisions that CEOs have been postponing. Many are waiting until after they report Q1 and Q2 2025 results to announce restructurings. That means the wave intensifies between now and mid-2026. The debt refinancing wall I mentioned hits hardest in the second half of 2025 and early 2026, creating additional pressure exactly when companies are already stressed. When millions lose income simultaneously, here is what happens to an economy. Consumer spending represents roughly 70% of U.S. GDP. That spending doesn't just evaporate abstractly. It translates into immediate, tangible damage across every sector that depends on people having money to spend. Restaurants see traffic drop 20%, 30%, sometimes more. They lay off servers and kitchen staff. Retail stores watch foot traffic collapse. They close locations and terminate employees. Travel and entertainment spending, which are pure discretionary categories, get cut first and deepest. Airlines, hotels, theme parks, concert venues all see bookings crater. These sectors employ millions of Americans at wages that don't permit much savings cushion. Now here is where it gets worse. Those newly unemployed workers immediately cut their own spending, which creates the next wave. The restaurant worker who just lost her job stops going to the salon. The salon cuts hours for its stylists. Those stylists stop buying new clothes. The retail workers get fewer hours or lose their jobs entirely. Each wave creates the next one. Housing markets feel it quickly. Mortgage and rent payment stress shows up in the data within 60 to 90 days of job loss. Delinquencies rise, evictions increase, foreclosures begin their slow process. Capital doesn't wait for official recession declarations. Markets price in job losses before they show up in government statistics. I've watched this dynamic play out over decades. And what I'm seeing now in market psychology tells me investor confidence is already cracking. Stock market volatility has increased noticeably over the past 6 months. The VIX, which measures expected volatility, has been elevated and jumpy. Every time weak employment data gets released, you see sharp sell-offs in consumer discretionary stocks, the retailers, restaurants, auto companies, anything that depends on people having secure jobs and disposable income. Investors are rotating out of these sectors and into defensive positions, utilities, healthcare, consumer staples. That rotation reflects a belief that the consumer is about to weaken significantly. Corporate equity issuance is essentially frozen. Companies that might have raised capital through stock offerings in 2021 or 2022 can't do it now at reasonable prices. That matters because it means they have fewer options when they need cash. They can't easily go to the equity markets, and debt is expensive. So they cut costs, which means cutting people. The venture capital and private equity worlds have pulled back dramatically. According to recent data, venture funding in the first half of 2025 was down nearly 40% from the prior year. Private equity firms are holding on to cash rather than deploying it into new deals. That means fewer startups get funded, fewer expansions happen, and crucially, the companies that took private equity money in recent years are now under immense pressure to show profitability. The path to profitability when revenue isn't growing fast is straightforward: layoffs. The IPO market, which was roaring in 2021, is essentially closed. Companies that plan to go public and use those proceeds to fund growth are stuck. Their employees who expected stock options to become valuable are watching those dreams evaporate. Many of those companies will have to shrink rather than grow. And that means workforce reductions. There's a feedback loop forming that worries me deeply. Weak employment data causes market sell-offs. Market sell-offs destroy household wealth, retirement accounts decline, home values soften, investment portfolios shrink. That wealth destruction causes even employed people to cut spending because they feel poor. Consumer spending data weakens, which triggers more corporate cost cutting and more layoffs, which feeds back into weaker employment data. Each turn of this loop reinforces the last. I've seen this pattern before. In 2008, it took about 6 months from the first cracks in confidence to full-blown panic. The mechanism was different than it started in housing and credit markets, but the psychological dynamic was identical. Once capital decides the environment is unsafe, it retreats. And that retreat creates the very conditions it fears. Business confidence surveys are flashing warning signs. The CEO confidence index has declined for 4 straight quarters. Small business optimism is at levels we typically see during recessions. These aren't lagging indicators. These are the people who make hiring and firing decisions telling you what they plan to do next. So where does this lead? Let me think through the range of possibilities, because as an investor and as someone who cares about this country, I need to consider multiple scenarios, not just hope for the best one. The baseline scenario, the one I think is most likely, involves somewhere between 2 and 3 million job losses over the next 12 to 18 months. That would push the unemployment rate from the current 4.2% to somewhere in the range of 6% to 7%. That's not Great Depression territory, but it's substantial and painful. It means millions of families facing real hardship. What could moderate this outcome? Faster action from the Federal Reserve in cutting interest rates, though I'm skeptical that will happen soon enough or aggressively enough to matter. Major fiscal stimulus from Washington, which seems unlikely given the political environment and concerns about deficits. Or perhaps productivity gains from AI and automation could be absorbed without massive displacement if companies grow revenue fast enough to redeploy workers rather than eliminate them. But I don't see strong evidence for that optimistic path. The acceleration scenario worries me more. If we get a credit crisis on top of the employment weakness, meaning banks start pulling back lending aggressively because they're seeing defaults rise, then this could cascade much faster and deeper. If the housing market corrects significantly, that destroys household wealth and confidence simultaneously. If there's a global slowdown that hits our export sectors hard, that adds another layer of pressure. In that scenario, we could be looking at job losses closer to what we saw in 2008, which was over 8 million jobs lost and unemployment above 10%. History gives us some guideposts. The 2001 recession saw about 2.7 million jobs lost over roughly 18 months. The 2008 crisis was far worse, over 8 million jobs lost over 2 years. The difference between those two episodes was the presence or absence of a financial system crisis. In 2001, we had a tech bubble burst and corporate malfeasance, but the banking system stayed intact. In 2008, the banks themselves were failing. Credit froze completely, and that amplified everything. Right now, I don't see a 2008-style banking crisis forming. The banks are better capitalized than they were then. But I do see the employment pressure building from structural forces that aren't easily reversed. The question is velocity and magnitude. Some sectors will recover relatively quickly once conditions stabilize. Construction usually bounces back when interest rates eventually fall and housing demand returns. Some manufacturing can restart when orders pick up. But the jobs and categories being permanently automated or outsourced aren't coming back. Middle management positions eliminated through AI and restructuring are gone. Retail jobs lost to e-commerce don't return when the economy improves. My best estimate is that peak job losses occur somewhere in the middle of 2026, assuming current trajectories hold. Stabilization after that depends on how aggressively policy responds and whether we avoid compounding crises. But even in the better scenarios, we're talking about a difficult 2 years ahead for American workers. I've lived through 13 recessions in my lifetime. I've watched markets crash and recover, watched industries disappear and new ones emerge, watched millions lose jobs and eventually find new ones. What I've learned through all of that is this: you can't predict exact timing, but you can prepare for what's likely coming. If you're an investor, the preparation is straightforward. Build liquidity, hold more cash than feels comfortable, reduce leverage. If you're carrying debt on margin or other borrowed money in your portfolio, pay it down. In uncertain times, the cost of being wrong about timing is too high. I'd rather hold cash that earns 5% in treasury bills and miss some upside than be forced to sell stocks at the bottom because I'm over-leveraged. Look at defensive positioning. I'm not telling you what specific stocks to buy, but I will say that companies with strong balance sheets, consistent cash flow, pricing power, and products people need rather than want tend to hold up better. Berkshire's portfolio has been shifting in that direction, and that's not accidental. For those of you who are employed and worried about your job security, the same principle applies. Preserve optionality. Build an emergency fund if you don't have one. 6 months of expenses is the standard advice, and it's standard because it's sound. Reduce monthly obligations where you can. This isn't the time to stretch for a bigger house or a luxury car purchase. Strengthen your professional network now before you need it. The time to build relationships is when you don't desperately need a job, not after you've lost one. Invest in skills that are hard to automate or outsource, deep expertise in complex problem solving, genuine creativity, jobs that require human judgment and relationship building. These remain more secure. If your current role is vulnerable and you know it, start positioning for a transition while you still have income and time. Here's what I actually do in periods like this, not just what I advise others to do. I look for quality assets that are being sold indiscriminately because fear has overtaken rational valuation. I don't try to catch the exact bottom. I wait for clarity about which businesses will survive and thrive, and then I act. In 2008 and 2009, when everyone was panicking, Berkshire invested billions in companies like Goldman Sachs, General Electric, and later in various opportunities that presented themselves. We didn't know exactly when things would turn, but we knew they would eventually, and we had the cash to act when others couldn't. But I want to be clear about something. There's a difference between investor opportunity and human suffering, and both are real. Markets will recover. They always do eventually. Capital finds its way to productive uses, innovation continues, and economies rebuild. But individual lives don't always recover as cleanly. A person who loses their job at 55 and struggles to find equivalent work before retirement may never make up that lost ground. A family that loses their home may carry that financial and psychological damage for years. These aren't just statistics. They're real people facing real consequences. So I acknowledge both truths. As an investor, I prepare for opportunity. As a citizen, I recognize the cost. This isn't callousness, it's realism. The economy will eventually stabilize and grow again, but we're going to go through a difficult period first, and pretending otherwise doesn't help anyone. The cost of being wrong about whether this happens is much lower than the cost of being unprepared if it does. If I'm overly cautious and the economy somehow avoids significant job losses, the worst that happens is I held too much cash and missed some gains. If I'm right and you're not prepared, the consequences are far more severe. My warning at the beginning wasn't meant to cause panic. It was meant to create respect for what I believe is coming. Those who listen, who prepare their finances and their careers, who build resilience and maintain optionality, they'll navigate this period far better than those who ignore the signals because they're uncomfortable to face. That's the lesson I've learned over and over across 95 years. Respect reality, prepare without panic, and maintain the resources to act when others can't.